Good morning, I'm Chris Reach, and welcome to Charting the Markets on IG Live. And calm has descended to an extent across global markets. Equities certainly have rebounded. European markets having a solid couple of days, really, firmly off their lows of yesterday's session, as some of the excitement, madness, call it what you will, of the weekend and the takeover, bailout, rescue of Credit Suisse, again, you can call it what you will, subsides. Obviously, the disappearance of a major global bank, and I think we forget how big Credit Suisse was in its heyday, would send jitters through global markets, especially with the Fed meeting in the same week. So it's understandable that we had quite a bit of volatility. And of course, by volatility, we mean losses really yesterday morning in indices, particularly, but those have rebounded, particularly, as I say, in Europe for 200. We'll see in a second back above the 200-day moving average. The DAX also very strong. What looks like, certainly for the DAX, just a higher low and the establishment of more of an uptrend in many ways. Moving over to the US, it's a bit more muted, but still there as well. Recovery in stocks underway. Over to FX markets, the dollar continues to weaken to an extent. So again, it's just risk is back on this week more than it certainly was last week. So that's why you've got the pound and the euro trying to move higher against the dollar, a bit more mixed on the dollar yen front. Meanwhile, commodities, oil, of course, took an absolute drubbing yesterday, fell to another 1 year plus low before again recovering. So a bit of a recovery there. Gold briefly touched 2,000 and looking quite solid as well over the past couple of days. So very, very strong performance there from gold. Just as, interestingly enough, inflation starts to ease. So gold, as the classic inflation hedge, doesn't quite work out that way. It seems to be much stronger in the wake of strong periods of inflation. But we'll come to the price action of that in a second. Generally, it's a slightly quieter day. Today is probably the calm between two storms after yesterday's Credit Suisse fun. And tomorrow, of course, with the Fed meeting, not much to report so far today. We do get Canadian CPI, so there isn't a complete escape from the inflation picture. But of course, the Bank of Canada, they're pausing in its most recent meeting. So that issue seems to have diminished in intensity for the time being. And so starting with the indices, beginning as ever with FTSE 100, currently trading at 75.03, back above the 200-day moving average. So the bulls can chalk that one up as a success. I think we briefly dropped down yesterday to the low for the session was 72.03.8. That was the lowest level since the beginning of November. So that's essentially a 4 or 5 month low for the index, wiping out all the gains made since then. But we find ourselves back above, as I say, the 200-day, back above 7,500 just nudging Friday's highs now. 75.11 was the high from Friday's session, and we saw the price has got back to that level essentially. So that's a very solid performance there, really. As again, very much like what we saw in December, where the index dropped below the 200-day and then rebounded, we find ourselves back above it. So whilst we couldn't really say it's firmly bullish again, it's certainly more neutral than it was yesterday, where the sellers once again seem to be gaining the upper hand. So if we can go above, say, 75.10, and then also you've got a bit of intermediate resistance, shall we say, around this kind of zone, around 75.15, then on to the 100-day and 76.40. That would be the highs from last Tuesday. If we can clear those are the sort of stumbling blocks on the way to the upside, then you've got some more interesting elements come into play around 77.50 and then onwards really towards 8,000 over the course of time. But a very good start to the day for the FTSE 100, rallying from the lows down at 7,200 yesterday. Over to the DAX, and there again, story of a very strong rebound. And of course here, huge recovery since October. I keep calling it recovery. It probably has moved beyond that stage now. But from October, we were down at 12,000. You've seen it rally all the way through into February and then start to stall. But crucially, and I think this is important to look at the gauge of the measure of how far the price fell. Whereas the FTSE 100 went all the way back to the 200-day moving average, the DAX only, he says in inverted commas, only went down to 14,600. That was still 1,000 points in the space of a week. But after having gained some, well, 3,500 points really, trough to peak, more or less, since October, that's the kind of volatility you expect. And indeed, it mirrors the losses of December, where we went from 14,600 to 14,000, or 13,800 really, before rebounding once again. So again, it's about picking your moment here, really. This is now firmly, I think we'd have to say, so long as the price doesn't reverse in the next couple of days back below 14,600, this is now firmly in the higher low camp, which simple trend analysis teaches you is good for the uptrend, pull back, but buyers have come in and the sellers have been unable to wrest this one back below and keep it below the 100-day moving average. So that's a very conclusive bounce, I think, there, and sends a message that maybe we are back on track for a move to the highs of early March around 15,700 and potentially higher from there. It is, of course, quite simplistic, but there's essentially the price telling us that there was plenty of appetite to buy the index around these levels and clear the way then for a push to the upside. So we're not saying we'll get there straight away, but certainly the strength has certainly come through once again. And the bullish view arguably remains in place here unless and until we see a move back below 14,500, and then we'll have to reassess. But for the moment, buyers have reasserted this. We're still waiting for the MACD crossover down below here. Usually by the time that happens, of course, the buyers have firmly got control. But yes, that's certainly the moment. Looks like the bullish view has reasserted itself for the DAX. So for the moment, the DAX stands out, I think, really as the strongest one of these three. If we're looking at the S&P, again, though, decent recovery here. You actually have got, brace yourselves, bullish MACD crossover down here for the first time since late December. In fact, since the beginning of the year. That was followed up by a big bounce. So it's interesting that, again, despite being a miserable performance since October, especially compared to the DAX, the US has managed to hold itself steady and avoid further losses. And these big wicks, and we should have talked about this in the other two indices as well, but these big wicks all the way through the last week shows there was plenty of appetite to buy on the lows here, which in the end has resolved into a move higher. Of course, it could have resulted into simply being sent back down again. But the fact that it has been able to recover, hold above 38.50 and above there around this sort of 38.50 kind of zone is an interesting point. Then it's back above the 200-day, which is a good point. It's now back above the 100-day. And as with the FTSE 100, it is now, in fact, in this case, S&P futures are moving above last Friday's highs. So once you take it all away and you take all the way the references to support, resistance, and moving averages and all that, the simple fact is the price has been able now to get back above last Friday's high, having recovered from Monday's lows. There's clearly a degree of buying pressure going on there. The next target then becomes these early March levels around 4,060, which is interesting because that was an area of brief support throughout February. A couple of times it dipped below that level and then bounced, but then eventually couldn't hold it. And then at the beginning of March, where it did go back above 4,050, it then ran into some selling. So we'll see what happens then when it gets back to this level, which is the next level to watch out for, really. And again, we talk about the levels to look out for, not as if they will be important, but they were important last time. That's the point. Technical analysis has to be, by its definition, somewhat of a rear view mirror exercise, and it has, these were the important levels the last time we were around here, so it's worth watching out for that and see whether we can get back above that. Of course, if they can, that's a big tick in the bullish box and then argues for a further move towards 41.50. And as with the other two indices, we need to be back below 38.50 to suggest that the sellers are in control once again. Turning to FX markets, again, it's a softer dollar story. It's a risk-on story, if you like, after the last couple of days. Indeed, since last Thursday, really, the dollar has weakened notably. So if we're looking at this against the euro, we're back above 107, we're back above 107.50, and indeed poking our way above the 50-day moving average once again. So not quite so much such an elegant uptrend for the euro dollar against for the euro dollar compared to the DAX, really, but nonetheless, dips into this zone around 105, found buyers, and a bit higher during the course of March. Now the big litmus test for this is, has it got the strength to move on through here? Because this was the area where tempted rallies in early February faltered and we headed lower, and then last week we just edged into that zone and then fell back for whatever reason, but the price action is there. So if you get back above that and then 108, that's another strong indicator that the buyers continue to remain in control here. It is a bit of a range, I suppose you could argue. Dips down to 105 and then up to 107.50. So we'll see if it's got the strength to break out of that and then clear the way towards 110. So a very strong performance there. MACD has been bullish here all the way through last week. So that sort of counters the view that it was firmly a risk-off week across the board. But what we've had here was big rally from November. This has been the first real bit of consolidation we've had, I think. We've had a big jump, pullback, then sideways movement to frustrate everybody. But the dip buyers coming in conclusively over the last month, really, to push this one back towards 108 and then potentially higher. for the pound as well. Despite all the trouble of the UK economy, again, softer dollar here has helped things to push on. Of course, you've got the BOE this week as well, so it's very much a case of be careful with volatility if you're trading this, because you've got the Fed tomorrow to affect the dollar side of the equation, and then you've got the BOE on Thursday to affect the sterling side of things. So a bit trickier here, perhaps, but certainly the fact we are again above the 50-day, we are now testing this area around from Valentine's Day around 122.70. So if bulls can love that one a bit more, then we could see maybe move back towards 124. This is the key one, I think, here, that twice since December we've tried to push on above this level and it hasn't really gone anywhere. So that's your sort of next point to bear in mind. And of course, it coincides quite nicely just about with that brief high we had at in the middle of June at 124. So an interesting area to watch there, really. And more or less, I suppose you could argue the pound has been ranging since mid-December, really, to 124, down towards 119, back up again, back down. And now we see whether the third time will be the charm here, whether that changes the narrative for the pound against the dollar. And then on dollar yen, unsurprisingly, a bit of a bounce this morning after the sharp downward move of the past 2 weeks, really. Dollar yen top ticking the 200-day moving average elegantly and then reversing from there, falling back below the 100, falling back below the 50, just trying to recover today. So this one perhaps more in play here from a bullish perspective. Is this going to be a bounce off trendline support from the January lows, which is one way of looking at, of course, and don't forget, when you're looking at other people's charts, time frames might be different, views might be different. Or is this simply a short-term rebound following on from this big decline, huge decline here, arguably a lower high here, big pullback. Now is it going to bounce, or has it got maybe some bit more strength, and then it's going to crash through 130.60 and then head on back down towards these lows around 128. We'll of course find out. So much of this hinges on the Fed. We can say that about every market this week, but of course what the Fed will do tomorrow. At the moment, expectation is for a 25 basis point hike and what they call a fairly dovish bit of commentary around it, i.e. the Fed saying we'll probably pause from here. We think the recent excitement, instability, call it what you will, has made the outlook a bit more difficult to call in a way, because banking crises, as our analyst Tony Sycamore in Australia was saying in his update this morning, banking crises tend to be deflationary. They tend to constrict economic activity and constrict inflation as well. So that essentially does the Fed's job for them in a different way. So this is the key thing to watch out for here. Has the dollar's run come to an end? As this rebound has been that, again, that short-term reaction to the huge losses from November. Now we go back. But just unsurprisingly, talking in the very short term, downward move over the past 2 weeks. Here was a bounce should have been expected, but if it can't even get back up the 50-day today, that would be a big tell. I think that the sellers are beginning to wrest control here on this one too. And then finally, commodity markets. Gold, unsurprisingly, huge beneficiary of last week. We went from 1820 to 2000 yesterday morning in early trade. The first time we've touched the magic 2000 level, psychologically important 2000 level, since April of last year. So well done on the round trip, everyone. It was a fun ride while it lasted. Again, talking of trends, big pullback here during February and March. Very, very tough one for the buyers to sort of sit out and wait, but they got their reward eventually, that we found a low around 1800. Bullish MACD crossover, bit of a reversal, and then bounce for whatever reason, but the price is there. So after a huge move higher, I think it would be silly to expect it to keep going in this kind of straight line move, but certainly the buyers resting control here, establishing a higher high around 2000. So we wait to see whether this resolves in some consolidation over the next couple of days. Again, the Fed is the inescapable element here. Whether if you're sitting on it from down at 1800, you're probably just going to have to wait and see what happens, really. If you're not in gold, it's one of those moves where probably best not to try and chase it at this point after this huge straight line move, but to wait and see what happens and maybe pace yourself, especially with the Fed tomorrow. So we'll see how this resolves, really, but consolidation would be my best guess at this point in time. And then finally, crude oil, absolute dropping over the past week or more, sitting happy at $80 a barrel, 7th and 8th of March, and then whoosh down towards 65 in almost the blink of an eye after a very impressive consolidation effort throughout December, January, and February, and then suddenly down towards 65. New lows here, the lowest level there since December of 2021. So again, there's one deflationary element, at least, even if you're not quite seeing it at the petrol pump just yet. Nonetheless, sellers firmly in charge here. Buyers happy to step in, though, around 65. So we'll see whether they can just get this one maybe back towards my thinking we're probably back towards 73.40, 73.50 in the hope that maybe they can hold it there. But then you'd expect maybe that to be the stumbling blocks. It was such big support in the first 2 months, 3 months of the year, that it will be, I think, a big level to break to the upside, and quite a tough one to do. So watch that one really. Just as the reverse of gold, we've had a big downward move, probably consolidation, the most obvious thing to expect at this point, before things start to resolve. Unless, of course, you get an OPEC statement or a meeting, and that occasionally could be the risk that then causes a cut in production and the price rebounds. But at the moment, sellers just about still in control, but maybe a bit of a rebound necessary to clear the air after this sharp downward move through the course of March. So looking ahead to the rest of the day, as I say, Canadian CPI and then US existing home sales on the calendar for the day. Nothing really too exciting, with all due respect to Canadian CPI. Of course, it's about the Fed, which is tomorrow, 6 p.m. Don't forget that's slightly out, and it's an hour early expected because of the US clock change. So we get the 6 p.m. Statement and the 6:30 p.m. press conference. So we expect some volatility around that event, with everything else expected to be secondary to that. We're expecting the Dow, again, a slightly more positive open expected for US stocks after 2 days of strong gains, but you can expect some nervousness to set in as we start to sit down and wait to watch Jerome Powell has to say tomorrow. But that's it for me. Thank you for joining us, and we'll be back tomorrow as normal at 10:30.